Good day, everyone. Today, we are going to discuss one of the most critical aspects of transfer pricing, which is comparability analysis, which is under Module 6, conducting a comparability analysis. This process ensures that the transactions between related parties in a multinational enterprise comply with the arm's length principle. Essentially, this principle dictates that the pricing for goods, services, or financial arrangements between related parties should be comparable to what would have been agreed upon by independent, unrelated parties under similar circumstances. Through comparability analysis, we can validate whether the control transaction reflects an accurate market-based pricing approach, ensuring compliance with both local tax laws and global standards set by the OECD transfer pricing guidelines. In today's session, we will explore the following in detail. What is comparability analysis? Step to conduct comparability analysis, functional analysis and its importance, making adjustments to enhance comparability, statistical method in comparability analysis, case studies to illustrate comparability analysis, and then we can then look at conclusion. So before we even go to overview of identifying comparable transaction, what is comparability analysis? So I'm going to define comparability analysis. Comparability analysis is the comparison of a controlled transaction, one between related entities, against an uncontrolled transaction, one between independent or unrelated entities. Let me say that again. Comparability analysis is the comparison of a controlled transactions, that is, transaction between related entities, against an uncontrolled transaction, the one between independent or unrelated entities. Now, this comparison is performed to determine whether the controlled transaction meets the arm's length standard, whether it mirrors what would happen in an open market under similar economic circumstances. Now, the arm's length principle ensures that income is not artificially shifted between related entities to exploit tax advantages in different jurisdictions. Now, comparability analysis is therefore fundamental in preventing base erosion and ensuring each country receives its fair share of tax revenue. So now let us look at the steps. Steps in conducting comparability analysis. We've looked at overview. Identifying comparable transactions involve finding uncontrolled transactions that are similar to the controlled transaction under review. This transaction should be between independent parties and occur under similar circumstances. So a systematic approach to comparability analysis is required to ensure its accuracy and reliability. So below are the key steps that are involved. One, you need to identify the controlled transaction. The first step is to clearly define the controlled transaction, which could involve the sale of goods, provision of services, licensing of intangibles, or financial arrangements such as intercompany loans. So these steps involve understanding the economic terms, pricing structure, and contractual obligation between related parties. It is crucial to gather detailed information on the transaction, such as nature of the goods or services, the terms of the agreement, parties involved, and all that. So then secondly, now after we identify the control transaction, the second thing is to identify potential comparables. So once the control transaction is identified, the next step is to search for uncontrolled transactions. This could be internal within the company, maybe between unrelated parties, or external, publicly available data on transactions between independent parties. So this internal comparable transaction between the multinational enterprise and third parties, then external comparables, data sourced from external database or from external databases or public records, which can be found in commercial databases, industry reports, public findings, or market studies. So this phase is critical to finding transactions that closely match the controlled transaction in terms of economic characteristics. Now, what the next step is to compare the uncontrolled and the controlled and the uncontrolled transaction. So at this stage, we compare the controlled transaction against the potential comparables identified. To ensure a meaningful comparison, the following factors should be considered too when you are doing these, when you are comparing the controlled and uncontrolled transaction. You need to consider the functions performed, the risk assumed, the contractual terms, the economic and market conditions, characteristics of the property or services transferred. So these factors allow us to establish whether the transactions are economically comparable and whether the uncontrolled transaction can serve as a reliable benchmark for the controlled transaction. Now, let us look at, I'll come back on the case studies. Let us look at the, conducting functional analysis now. A functional analysis is a core component of comparability analysis. It involves analyzing the specific activities that each party to a transaction performs, the asset they use, and the risk they bear. This allows us to understand the economic contribution of each party in generating value from the transaction. The three key areas in the functional analysis are functions performed, that is identifying the specific roles of each party, whether it is manufacturing, distribution, or research and development. For instance, a manufacturer may perform assembly, quality control, and logistics, while a distributor might focus on marketing and sales. On assets used, assessing both tangible and intangible assets involved in the transaction. Tangible assets include machinery and real estate, while intangible might involve intellectual property like patents or even trademark. Now, the risk assumed, evaluating the type of risk each party bears, such as market risk, product risk, or even research and development risk. For example, the entity responsible for research and development might bear the risk of product failure, while the distributor assumes the risk of unsold inventory. So let's even look at it. Why is functional analysis important? Why is it important? It is important because it ensures that each party's compensation is consistent with the value of their contribution. Yes, it also helps select the most appropriate transfer pricing method, and it also justifies the allocation of profits or losses within the multinational enterprise. So let's look at a Nigerian manufacturing company that sells its product to a related party in Europe. A functional analysis revealed that that company or the manufacturing company handles all production and bear the associated production risk. The European subsidiary, on the other hand, handles only distribution and customer support. So with minimal risk, based on the functional split, the pricing must reflect the company's higher risk and asset utilization, ensuring its compensation align with its role. Yes, they must ensure. So let me just read that again. A Nigerian manufacturing company that sells its product to a related party in Europe. Now, in functional analysis revealed that the company handles all production and bear the associated production risk. The European subsidiary, on the other hand, handles only distribution and customer support with minimal risk. So based on this functional split, the pricing must reflect the company's higher risk and asset utilization, ensuring its compensation aligns with the role. So the Nigerian manufacturing will get a higher compensation based on the role and based on the higher risk and asset utilization they have utilized. Okay, making adjustments, now making adjustment to enhance comparability. In many cases, it is very difficult to find an identical uncontrolled transaction that perfectly matches the control transaction. It is very, very difficult. So in such instances, adjustments are made to account for differences, allowing for more accurate comparability. So the common adjustment that which is usually done is volume adjustment if the control transaction involve a higher volume than the comparable. So the price might need to be adjusted for economies of scale. For example, a bulk sale might receive a discount, while smaller quantities may be priced higher per unit. Even on geographic adjustment too, differences in market conditions, across regions might require price adjustment to account for varying cost structures, competition level, or consumer behavior. Example, when a product sold in high demand, low competition market will likely fetch a higher price than the same product sold in a more saturated market. Then in terms of contractual adjustment, differences in payment terms, e.g. credit periods, advance payments, can impact the comparability of transaction as well. For example, if a 90-day credit term might necessitate agreement or might necessitate adjustment to align with comparable transactions that involve cash payment on delivery. So for example, if a company GHI Limited, a Nigerian data limited that exports or that sells product to its related company. For example, a Nigerian export company sells product to its related party in Europe and to independent customers in Africa. The price in Europe and Africa are influenced by different market conditions. So GHI Limited makes geographic adjustment to the prices to account for these differences, ensuring that the European prices are adjusted to reflect African market condition. So it is very, very important. Another thing that I want to talk about is the statistical method in comparability analysis. This is when you are conducting comparability analysis, the results often yield multiple potential comparables. In cases where the comparability of these results varies, statistical methods can help refine the analysis and ensure accuracy. One of the most common used approaches is the interquartile range, IQR, interquartile range. So let's even define what exactly is the interquartile range. The interquartile range represents the middle, that is 50% of data points from a set of financial results, eliminating the influence of extreme values, outliers. By focusing on this range, multinationals and tax authorities can arrive at a more reliable estimate of the arm's length principle. So why do we use this IQR, the interquartile range? It reduces biases, it minimizes the impact of outliers that could distort the pricing analysis. Reliability, it focuses on the central tendency of comparable transactions, which typically provides a more accurate reflection of market conditions. Now, if you look at another case study in this particular manner, in Nigeria, let's look at JKL Limited, a Nigerian pharmaceutical company, that sell patented drugs to its related party in Asia, and JKL identifies several potential comparables from independent transactions. After making adjustment for geographic and volume differences, JKL screens these comparables for reliability and similarity. Through sensitivity analysis, it determines that 3 comparables consistently provide the most reliable arm's length prices. These are selected as the best comparable for the transfer pricing analysis. And another example using this same, let me just rephrase it again to suit our interquartile range. For example, this same Nigerian pharmaceutical company finds 5 comparable transactions when performing comparability analysis. However, 2 of these comparables show profit margins that are significantly higher or lower than the others due to market anomalies. So by applying the interquartile range, JKL Limited focuses on the middle, which is the 50% of results, ensuring that outliers do not distort the transfer pricing analysis. So I've explained that using this same scenario, but in a different manner. Now, let's just look at before we go there, let us look at some other case studies to illustrate comparability analysis. So let's look at two practical studies to further illustrate comparability analysis. Let's look at a manufacturing and distribution company. So using a Nigerian automotive manufacturer, for example, sells parts to its European subsidiary for assembly. To establish whether the pricing complies with the arm's length principle, the company must conduct a comparability analysis. Now, let's use the steps as follows. Functional analysis: ABC or the company performs all the manufacturing while the European subsidiary handle marketing and distribution. That is for the functional analysis. Now, you've identified the functional analysis. Now, for identifying comparables, the same company finds several external distributors in the European market for similar automotive parts. That is, they identify comparables. Several external distributors were identified. Now, economic adjustments were made for differences in distribution volume and market condition in Europe. The final outcome now, the transfer pricing is adjusted based on the interquartile range, ensuring compliance with both Nigerian and European tax regulation. This is just another example. Let's look at another case study, a software licensing scenario now. A Nigerian tech company licenses its software to a related party in the US and Asia. The licensing agreement must adhere to the arm's length principle. So now let's say they follow the following step. They did a functional analysis, develops the software. So that company developed the software. That's the Nigerian company now. The Nigerian tech company developed the software. Assume all the research and development risk. So its related parties provided customer support in their own respective region. That is the functional analysis. You can see that the Nigerian tech company is the one taking the high risk, is the one that developed the software, is the one that assumed all the risk. So is the one that, that's based on the functional analysis of assets used, on functions performed, assets used, and risk assumed. So now identifying comparables, external comparables for the software licensing fees are found using a commercial database. So they are using a commercial database like the likes of maybe Biron Van Dyke, Thomas Reuters, etc. Now, having identified the comparable using this external database, they also use what we call the geographic adjustments. Adjustments are made to reflect the differing economic condition in the US and Asia. Because if you remember, the Nigerian tech company licenses its software to related parties in the US and Asia. So you must also make the geographic adjustment. Now, the final outcome is that the tech Nigerian company applies the interquartile range to determine that its pricing for the licensing agreement is within the arm's length range. So it is very, very important that, I'm trying to just give more example with respect to this interquartile range, IQR, for our understanding. So in conclusion, a robust comparability analysis is essential for ensuring that related party transactions are priced at arm's length by carefully identifying comparable transactions, conducting a functional analysis, and making necessary adjustments. Multinational enterprises can ensure compliance with global and local transfer pricing regulations. Additionally, the use of statistical methods such as the interquartile range, which we have been discussing, further refines the analysis, making it more reliable and defendable in case of tax audits or disputes. So in summary, comparability analysis is about ensuring fairness in global taxation and preventing profit shifting. And by adhering to best practices, companies can minimize tax risk and foster transparency across jurisdictions, Thank you so much for your attention, and I look forward to seeing you in the next session. Thank you.